So has the stock market ever felt like this, I don't know, this exclusive club that you just weren't invited to? Well, if that's you, then you are in the right place. We are going to cut right through all the noise and give you a real step-by-step guide. We're going to go from those common fears that hold so many people back to building the foundational knowledge you need for a real strategy. Let's dive in.
Look, this is a pretty stark fact, but it's one we just have to face head-on. And, instead of just throwing a bunch of theories at you, I want to start with a personal story. It perfectly illustrates why this happens and, more importantly, how you can make sure you don't become part of that statistic.
Okay, so this story, it goes back about 15 years, and it's about my own father. He decided he was going to get into trading, specifically in commodities like gold. He was really drawn in by that promise of making quick money, but he was missing the most crucial ingredient of all.
And I'm really not exaggerating here. He was trading on an old Nokia phone, okay? He wasn't looking at charts, he was just looking at a price ticker going up and down. He had absolutely no idea what a candlestick pattern was. I mean, he was essentially flying completely blind, making huge decisions based on a number just flashing on this tiny little screen.
And you know what made this whole problem even worse? Leverage. His broker let him trade with way more money than he actually had in his account. Now, leverage can be amazing, right? It can amplify your gains. But what people often forget is that it amplifies your losses just as powerfully. It is a tool that requires a ton of skill and caution.
So, the result? In a single night, he lost 10 lakh rupees. For our family at that time, this was a catastrophic amount of money. It forced him to take on debt, and I actually spent years of my own life helping to pay it back. I didn't start my financial journey at zero. I started from a deep, deep negative.
And right there, in that really painful experience, that's the core lesson. The market can be an absolutely incredible tool for creating wealth, but if you go in without the proper education, it is far more likely to cut you. And that's why I believe so strongly that learning, step by step is the only way to approach it.
So, how do we build that foundation? Well, we start from the absolute beginning. Let's just forget about all the complex charts and jargon for a minute and focus on the really basic components that make the entire system actually work. At its very heart, a stock or a share, it's really just a tiny piece of a company. So when you buy a share of, say, Tata Motors, you literally own a very small fraction of that business. Companies do this to raise capital, to get money, so they can fund their expansion, their research, and their growth. Now, that very first time a private company decides to offer these shares to everybody, to the public, that's called an initial public offering, or an IPO. You can think of it like the company's big debut on the stock market, where pretty much anyone can become a part owner. But, and this is a big but, it is so crucial to understand that IPOs are not some guaranteed lottery ticket. Take Tata Technologies. Its IPO was a huge success. Investors made amazing gains on day one. But then you have the other side of the coin, the Paytm IPO. That resulted in major losses for the initial investors. So the key takeaway here is pretty clear. Research is absolutely essential. So where does all of this buying and selling actually happen? Well, it happens on an exchange. In India, our two main ones are the National Stock Exchange, the NSE, and the Bombay Stock Exchange, the BSE. Just think of them as these giant organized marketplaces that connect millions of buyers and sellers every single second. Okay, so now that we know what all these things are, let's get into how it all really works. Because understanding the mechanics of a trade is what separates a calculated decision from, well, a blind guess. Every single transaction, it has two sides, just like any negotiation. The bid is the highest price a buyer is willing to pay for a stock. The ask is the lowest price a seller is willing to accept for that same stock. And a trade only happens when those two sides finally agree on a price. Now that little gap between the highest bid and the lowest ask, that's called the spread. And this little detail, it might seem kind of boring, but trust me, it can have huge consequences. A small spread is great. It means lots of buyers and sellers are close in price. But a large spread, well, that can be really dangerous, as another true story will show you.
All right, so a trader I know was working with options on Havells stock. He had a position that was showing a really nice, healthy profit on his screen. It looked like the hard part was over, right?
So to lock in his winnings, he did what seems totally logical. He placed a market order to sell. That basically just tells the broker, hey, sell my position right now at the best available price. Sounds simple enough.
But what happened next was just shocking. The moment his order went through, his position didn't close with a profit at all. It closed with a loss. The money that he thought he had just made completely vanished, and he even lost more on top of that.
So how on earth is that even possible? I mean, think about it. He saw a profit, he hit the sell button, and he ended up in the red. The answer comes down to one of the most important and honestly most ignored concepts in all of trading. And the answer is liquidity, or in his case, a serious lack of it. See, for that specific Havel's option, there were very few buyers at that moment. The last traded price that showed his profit on the screen? That was old data. The nearest actual buyer was willing to pay a much, much lower price. That huge spread between the bid and the ask instantly turned his paper profit into a real loss. This is why understanding spread and liquidity isn't just theory, it's survival.
All right, we've covered the basics and we've covered the mechanics, but now let's zoom out a little bit. Because successful investing, it isn't just about picking the right stock, it's about building the right strategy for your life.
Let me ask you something. Just think about this for a second. If you found what you believed was the absolute perfect stock, a company that was just guaranteed to succeed, would you have the conviction to sell your house and put all of that money into it? I bet most people would say no. That level of confidence in a single company is incredibly rare, and probably for good reason.
And this brings me to a kind of surprising point about my own strategy. I invest heavily in the stock market. But if you were to look at my portfolio today, you wouldn't find a single individual stock in there. I sold every last one of them.
So where's all the money? Well, it's in exchange-traded funds, or ETFs. These are basically funds that hold a whole basket of stocks, like the top 50 companies in India, all bundled together. It allows you to buy the entire market with just one transaction. It's a way to bet on the growth of the whole economy, and you diversify your risk instantly without having to constantly watch dozens of different companies.
And this really brings us to the final and maybe the most crucial question you should be asking yourself. When you invest, are you painstakingly building a diversified, strategic portfolio that's designed for long-term growth, or are you just buying individual stocks, hoping that one of them is going to be a winning lottery ticket? The answer to that one question will define your entire journey in the market.